Yeah, my view is the US is underlying is weaker than people think. I think the views started to shift that way with the Q1 GDP data, but if you look at things like housing's been flat for 2 years. Normally when you see bond yields fall like they fall, housing should be accelerating. I think that speaks to a structural weakness in the States. And the other thing I think is really interesting is consumers aren't spending their gains from gasoline. And there's a weak industrial cycle. It's very weak, and it's not just I don't think a Q1 weather seasonal effect. It's been going on for the last sort of 9 months really, and it's to do with energy, the stronger dollar, and so on. In fact, in my view, people don't appreciate how much growth in the US has been driven by energy capex, energy-related activity, petrochemical industries, pipelines, and also agricultural business as well. Small part of the economy, but really a lot of capex, a lot of industrial capex has fed those industries. So, I think the US is industrially weak, the energy side's weak, the consumer's saving, because he hasn't had a recovery. Median household income is down in this recovery, not up. They're under pressure and they want to rebuild balance sheets, so they're saving gains from gasoline. And I think and housing is weak. So I think the US is underlying weaker than people realize. And that's, of course, why the dollar's started moving lower over the last month. Well, I think it's unlikely the Fed will raise this year. And I actually think if we can get the stock market down 15%, which to my view it's rolling over now, then I think we'll see the Fed may even do QE again this year. Now, the market isn't there. The market's debating whether or not we get a rate hike. Market prices have pushed that back, as we know, to December. I think market participants still pretty firmly in the September-December camp. But, I think the economy's too weak, and if we get that equity market down, things will change pretty quickly at the Fed, and they'll start doing QE, whatever number we're on.
And what will be the flow-on effect of that? What's going to happen in terms of how should people be positioning for that?
Well, that'll be fascinating because if that is the case, once that equity market's off, if we do get QE, then all the consensus trades will flip on their heads. So everyone's been into the yield plays, everyone's been playing Europe and Japan, and everyone's been underweight emerging market assets. Well, if we get QE, those are exactly the places you don't want to be. You want to be US overweight versus Europe rather than the other way around. You want to be overweight emerging market assets. You play sectors that are growth sectors, not yield sectors. And of course, you look for the curve to steepen. The curve always steepens on QE, and it flattens when QE stops, which is counterintuitive and not how most people see it. So I think it'll be fascinating because it really will flip the consensus on its head.